Good afternoon, everyone, and thank you for joining the Community Foundation of the Verdugos for this afternoon's webinar presentation. My name is Andrew Sisolak. I'm the Scout Executive CEO of the Verdugo Hills Council Boy Scouts and happy to be providing technical assistance to the Community Foundation's presentation this afternoon. We're going to get started in just a moment, so we're courteous of folks' time. This session is being recorded for later usage, just so you're aware. And with that, I'm going to go ahead and have Dylan Russell join us.
Hello, and thank you for joining us today. As the board chair of the Community Foundation of the Verdugos, I'd like to offer a warm welcome to all who are attending. As Andrew had briefly mentioned, we did want to remind you that the webinar is being recorded today. You should have received a prompt acknowledging the recording and allowing you to proceed. The Community Foundation of the Verdugos is very pleased to host this webinar on the proposed changes to the estate tax law, as well as viable charitable tax strategies. We will also touch briefly today on Prop 19. This is the second in a series of educational webinars that we hope provides many wonderful tips, not only on estate planning, but charitable giving for those in attendance, as well as your families and your loved ones. The foundation is very dedicated towards matching donors with the needs of those in our region. We are also dedicated towards education and topics of interest that we hope is not only a benefit for those attending, but for the community as a whole. And with that, I'd like to go ahead and introduce our moderator, Sheldon Eskin. He is not only a member of the Foundation's Board of Directors, but he also serves as the board president for the Salvation Army of Glendale. Following his diverse legal career in areas such as civil litigation, business, entertainment law, bankruptcy, and immigration, Sheldon transitioned his practice in 2010, where he honed his solid expertise in estate planning, trust administration, and special needs trust planning. Sheldon has prepared wills, revocable living trusts, irrevocable trusts, durable powers of attorney, advanced healthcare directives, and has worked with trustees to administer trusts and estates of all sizes. Sheldon is an avid fan of music, and prior to his career in law, he was involved in radio and the entertainment industry. It's interesting, he enjoys listening to jazz and blues and can be found producing his radio show called The Sheldon Eskin Show on arts and entertainment in his free time. So with that, I will turn it over to Sheldon.
Are we there, everybody? Hello. Hi, I'm Sheldon Eskin, and thank you to Lynn. I agree that information which can help anyone either get started in either estate planning or fine-tune their plans for themselves or loved ones. It's really something that we all need to make time for. As already mentioned, today's program will focus on proposed changes to the estate tax law, Prop 19, and the viable charitable tax strategies. If you have questions during the program, please use the question and answer button below to send them to our panel and our webinar administrators. We hope to end on time right at 5 p.m., after which we will answer as many questions as possible for those of you that wish to stay with us a little past 5. We have two great speakers who are making this webinar possible for all of us, Kevin J. Moore of Kevin J. Moore and Associates, and David Ellis, managing partner of Ellis and Ellis CPAs, Inc. Kevin will be starting our program off with proposed changes to the estate tax law and Prop 19. Kevin, I think what I want to do is I want to read your bio because it's very impressive. Kevin Moore is a very impressive attorney with great background. Kevin Moore has since 1992 been an estate planning lawyer based in Pasadena. Kevin's practice provides both transitional and litigation services to a wide array of affluent individuals and sizable, closely held and family-owned businesses. His transactional services involve sophisticated estate and tax planning that include an international dimension. Kevin's firm also represents owners of commercial and residential properties in disputes involving property tax assessments, as well as suits involving wills and trusts, ranging from allegations that a will should be set aside for undue influence to claims that the trustees breached their fiduciary duties. Kevin speaks regularly about estate planning and tax related issues to lawyers as well as financial advisors and accountants. He has spoken to organizations such as the Pasadena Bar Association, various chapters of Cal CPA, several estate planning councils throughout Southern California, and prominent accounting firms. Prior to founding his own firm, Kevin worked as an international business tax attorney with the law firm of Siphius and Partners in Salzburg, Austria. Over the course of his 4 years with the firm, Kevin became fluent in German and worked with clients to protect their wealth in connection with their domestic and international investments. Kevin received a Master's of Law, that's an LLM, degree in international taxation and business from McGeorge School of Law in Sacramento, a Juris Doctorate degree from Western State University in Fullerton, California, and a business administration degree in accounting from San Diego University. That's San Diego State University, to make sure. Kevin is an avid golfer, a diehard Dodger fan, a resurgent Chargers fan, and a third generation resident of Pasadena. And with that one now, I'm going to let Kevin take it away.
Well, thank you for those kind words, Sheldon. I really appreciate it. And as you said, I'm a diehard Dodger fan. You might add to that a diehard depressed Dodger fan, as it is right now. But nonetheless, a baseball fan, and I'm still watching the World Series. So baseball goes on. So I'm here today to speak about Proposition 19 update, to give a little update on what's happening with that, as well as some proposed changes to estate and gift taxes. These two topics alone would take a full day of a seminar, and I'm going to try to condense it into about 20 minutes. But I would feel free, and I would encourage you to write any questions that you may have, and we'll address them at the end of the program. So with respect to Proposition 19, if you recall, this is the proposition that was enacted just about a year ago, in November 2020. With respect to Proposition 19, it eradicated the parent-child exclusion, which is the primary focus of my update today. It also had done a good thing insofar as it allowed or expanded the use of the property tax transfer base. When you sell one home and you move to another home, you're able to transfer your old property tax base. And if you recall, if you're over 55, you can do that. And under the old law, it used to be that you could do it once. And as a general proposition, it had to be done within the same county. As a result of Proposition 19, it can now be done up to 3 times and can be done throughout the state of California. So it doesn't apply to just one or several counties. It does apply statewide. But other than that, that's really not the focus of Proposition 19. What its real intent to do was to remove the parent-child exclusion. So if you recall, before Proposition 19 was passed, transfers between parent and child were excluded from reassessment. So if you owned a primary residence, no matter what it's worth, no matter what its fair market value, you could transfer that property to your child, and vice versa. There was no restriction on that. You could also transfer property other than your primary residence, so commercial property or vacation homes, things like that. And that would only be subject to reassessment to the extent the assessed value, not the fair market value. You could transfer that property up to an assessed value of $1 million, a married couple $2 million, free of property tax reassessment. So that was huge. It allowed pretty much the transfer of California real estate between parent and child to be done on a property tax-free basis. Well, Proposition 19 passed, and as a result of that, it virtually eliminated the parent-child exclusion from reassessment. Now, transfers of primary residence between parent and child is not subject to reassessment, but only if the child uses the property as his or her primary residence. So that's one requirement. There was no such requirement prior to that. And then only to the extent that the fair market value does not exceed $1 million of the property's assessed value. So once it gets over $1 million of the assessed value, the amount over the $1 million of assessed value gets reassessed at fair market value. So now that's completely removed. Transfers of property other than your primary residence are all subject to reassessment. And the effective date of that was February 16th, 2021. This had a huge impact on many people. And for people engaging in estate planning, it was often the case where we transferred real estate, we transferred homes even, we transferred vacation homes into various kinds of trusts in order to move wealth from one generation to another. And while we can still do that, subject to what I'm going to talk about when we talk about the proposed changes to the estate tax laws, while you can still do that, it is much more difficult now to do that without causing a reassessment. And in a lot of cases, where we're dealing with either younger couples or middle-aged couples, you really have to weigh the consequence of transferring a property which causes a reassessment. And now you're going to be paying that higher reassessment for many, many years. You have to really calculate, well, is there really an overall tax savings with respect to that? If you've owned commercial property, all of that's going to be reassessed. If you have low basis residents or low assessed value residents, that could all be potentially subject to reassessment. It's funny, this proposition was initiated by the legislature under the guise of the California Real Property Association, the California Realtors Association. The real intent here was to force children who inherited property or received property from their parents to sell their property, to generate more sales of property. So as a result now, if you inherit commercial property and you get the income from it, a lot of that income now is going to go now instead into the child's pocket or savings. It's now going to go to pay property taxes. So oftentimes, and you see it where the kids make a decision where they don't want to keep the property at the higher tax base. It just doesn't make sense. So the Proposition 19, while it was pretty clear in what it did, it left a lot of holes. So there were a lot of unanswered questions as to many different aspects of the implementation of Proposition 19. And we've gotten some answers over the last 8-9 months from assessors themselves, from the Board of Equalization. They have drafted letters to assessors' offices of each of the counties and have provided guidance. The Board of Equalization has introduced property tax rules now, which have just recently become effective. And the legislature has also made some improvements in, or at least answered some questions with respect to the law. So some of those updates, some of those clarifications are, as I indicate here, only one child need occupy the property as a primary residence. That's true even if you transfer the property to all of your children. All of the children don't need to occupy the residence as their primary residence. Only one does. So that may seem pretty self-evident, but it wasn't clear, but now it's clear. The child doesn't need to occupy the residence right away on the date of the transfer. They don't need to occupy it right away on the date of the transfer, but they have to occupy it as their primary residence within 1 year of transfer. So that's been clarified. The child must make continued use of the property as a primary residence. So they can't just occupy it as a primary residence for 2-3 years and then leave and still get the parent-child exclusion. Once it no longer becomes a primary residence, it will be reassessed. But what's good is that at least it won't be reassessed at the fair market value on the date that the property no longer becomes the child's primary residence. It'll relate back to the actual date the property was transferred to the child. It'll be reassessed at the fair market value of that date, which presumably will be lower. And then, of course, it will be trended upward in value by no more than 2% per year in accordance with the normal Proposition 13 rules. So they've made that clear. The child must claim a homeowner's exemption. So those little cards that we get in the mail that says you can get a $7,000 homeowner's exemption from your property taxes, and oftentimes we throw those away. Well, a child actually needs to file for the homeowner's exemption in order to ensure that they get the parent-child exclusion. Also, if one child lives in the property as a primary residence and at a later time moves out, but another child moves into the property as their primary residence, that's okay. So you can tack on residencies of each children. So that's been made clear. Another thing that's been made clear is that there's no limit to the number of primary residences that may be transferred. So you transfer one to one child, you move into another place, it's your primary residence, then you now transfer that to another child, and that child lives in the property as their primary residence. You can do that as many times as you can afford to do that. So there are no constitutional challenges pending in any court in this state regarding the efficacy of or the constitutionality of Proposition 19. The legislature was trying to, or had some initiatives before some committees to delay the effective date of Proposition 19. Those have all come to a quiet death. There is some news on the horizon that the Howard Jarvis Taxpayers Association is attempting to craft a proposition that should be ready for the November 2022 ballot, which will reverse in some fashion this eradication of the parent-child exclusion. So that is pretty much the updates on, at least as pertains to the parent-child exclusion in Proposition 19. What I do want to get into now are some of the proposed changes to estate and gift taxes. I'm sure that many of you heard of all of the various proposals that are being bandied about, and the unknown, the uncertainty involved in what's happening in Congress and what are they going to do. And that's exactly what I really look at this as: uncertainty, uncertainty, uncertainty. Sitting here today, we really don't know exactly what Congress is going to do. We do believe they're going to do something. We have several proposals out there. We have the Bernie Sanders 99.5% Act, which was proposed in April 2021. Those had some pretty wide-ranging proposals that would turn estate planning as we know it, estate taxes as we know it, gift taxes as we know it, on its head. We have President Biden's tax proposals that were issued in May 2021 that were not as pervasive as the 99.5% Act. And then most recently, we've had the House Ways and Means bill that was passed out of the House. It actually passed the committee in September 2021. And all of these have, different provisions to them. And to this day, no law has been passed. No formal bill has been introduced to the Senate or to the House of Representatives. But we anticipate that something's going to happen probably shortly before Thanksgiving. And then, of course, we have daily news reports. I mean, you just open the paper and you hear about new proposals, the billionaire tax we've been hearing about the last several days, and the wealth tax, and a lot of things that are making the news. In fact, just today, right, a breaking news report came out that the Rules Committee of the House has issued a new bill that apparently does nothing with estate taxes and does nothing with changing any of the techniques that we've enjoyed or we've got to use over the years with respect to estate taxes. So there you go, right? We have these four things constantly coming about, just very difficult to predict. However, looking at all of these things, reading about all of these things, the conventional wisdom, we can kind of narrow it down with respect to estate and gift taxes. A couple things seem pretty likely to pass under any one of these scenarios. And that is, there's going to be, or likely will be, an acceleration of the sunset date for the reduction in estate and gift tax exemption from January 1st, 2026 to January 1st, 2022. So let me explain that a little bit. The current state of the estate and gift tax law right now, as we speak, if Congress does nothing, we each have $11.7 million to give away during our life or at our death. That's an extremely high amount. On January 1st, 2026, that amount is reduced no matter what Congress does, or if Congress does nothing. It's scheduled and will be reduced on January 1st, 2026 to about $6 million. So the idea is all they're going to do is accelerate that January 1st, 2026 date to January 1st, 2022. Doesn't take much, shouldn't be much in the way of browbeating anybody or pushing any or shoving or getting your legislation across. It's a pretty easy tax to incur. The other thing that is likely to happen and seems to be in all of the various proposals that are going about there is that they're going to eliminate various estate planning techniques that we estate planners use through the use of grantor trust. It would be beyond the scope of this presentation to go into what the nuts and bolts and nitty gritty of what a grantor trust is. Suffice it to say that many of you probably have these things in your already existing estate plans. So some of the type of grantor trust that we use in estate planning and have used for decades, I can't tell you or can't stress enough how pervasive the use of grantor trusts are in estate planning. And it's proposed that all of these techniques that involve grantor trust are going to be removed. So we have all of these acronyms here: IDGTs, intentionally defective grantor trust, a very common tool that we use to give property to our kids in trust and to not incur income taxes on that, and to get additional gifts into those trusts by paying the tax on the income generated by those trusts. SLATs, these are spousal lifetime access trusts, where one spouse may give property to a SLAT, to a trust, for the benefit of the other spouse. This is a grantor trust. An ILIT. This is something that probably many of you have, which stands for in a life insurance trust, an irrevocable life insurance trust. Typically, these trusts are all grantor trusts because the grantor's life is insured by the policy, and that in and of itself, and using the income from the trust, makes it a grantor trust. And many of you have these trusts, so that as a result, if you make further gifts to these trusts to pay the premiums on the life insurance policy, that could affect the efficacy of keeping that life insurance policy out of your estate, which of course is the purpose, or one of the purposes, for having the ILIT. Now, they've indicated that they're going to grandfather existing grantor trusts. So you don't have to fear if you already have an existing IDGT or SLAT or ILIT or QPERT, whatever the case might be. But there is a big red flag looming there that is stating that additional contributions, so contributions made after the effective date of these rules to these trusts will put them in the realm of the new rules, so that they'll be included in your estate, or at least a portion of these trusts will be included in your estate. And this could happen very easily with respect to, for example, irrevocable life insurance trusts, where you're making annual gifts to these trusts. By making annual gifts to the trust after the effective date, that insurance policy or a portion of it can be included in your estate plan. In your estate. So these will have wide-ranging, far-reaching implications. So what to do? First thing, of course, is see your estate planning attorney immediately. And really, it may already be too late. Your estate planning attorney may already be too busy and might already have his various clients set up. We only have maybe 2 weeks, 3 weeks, 4 weeks at the tops, probably. Again, we don't know. But estate planning attorneys are extremely busy. There's also a risk for making mistakes when doing work on such a quick basis. So many attorneys won't take a case in order to prevent any liability from coming about. But you should reach out to your estate planning attorney if you haven't done so already. Make gifts right now to your existing grantor trust. Use your exemption to the extent you can now, or at least be ready to make the gifts. There will be, we believe there's going to be a little window of time between the time that the House and the Senate pass the bill and then it gets signed by the president. The time between it coming out of Congress and being signed by the president, we're anticipating might be a week to 10 days. So you want to be ready during that period of time to make a gift to one of your grantor trusts. If you don't have a grantor's trust right now, and you're not sure if you want to make gifts, but you might, we're creating grantor trusts right now. Even though we may not be using them, or we may use them down the road next year or something like that. But we want to be ready to make gifts immediately if we have to. That's the key here. And you see a lot of estate planning attorneys and their clients doing this. Review your ILIT. If you have an irrevocable life insurance trust, call your estate planning attorney and start looking at some alternative funding arrangements. Instead of making gifts, you might be able to make loans to your trust. These are called split dollar arrangements. Nothing in the new rules or at least nothing significant in the new rules has done anything to remove split dollar arrangements, whereby you can make loans to your ILITs instead of gifting money to your ILITs. So these are just to name a few. Obviously, there's many other things that are impacted by the various proposals that are out there. We'll know more in the coming days for sure, but it does look like something will be happening, and we all believe that something will be happening for sure. What will be happening, we may not be so sure, but we can make some educated guesses here. Don't wait too long. You've probably already waited too long if you've waited this long, but don't wait any further. Contact your estate planning attorney. Thank you, Sheldon, and I'll pass the mic to you.
Oh, thank you, Kevin. That was a great, very great, concise overview. And for our attendees, remember, if you have questions, please submit them using the question and answer button, and we will address them at the end of the webinar. Now we're going to hear about some viable charitable tax strategies that our next speaker, David Ellis, will be presenting. And David, well, he has another excellent bio. We have two great speakers today. David Ellis is the managing partner of Ellis & Ellis CPAs located in Pasadena, California. And he has over 30 years of experience in the practice of divorce, trust estates, and other family tax matters. The firm also provides other general tax services and IRS representation. He is a frequent writer and speaker on various subjects and has provided continuing education services to the California Society of CPAs, the California Society of Enrolled Agents, the Family Law Section of the California Bar Association, and the Professional Fiduciary Association of California. He has served as tax advisor to the Office of the Public Guardian for the County of Los Angeles on matters of trust, estates, and corporate taxation in probate litigation. He is also the founder of the Women's Tax Resolution Center, Inc., a nonprofit organization dedicated to helping low-income women in Los Angeles County resolve their tax problems. David holds a bachelor's degree, it's a Bachelor of Arts degree in communication, and it's arts and sciences, let me get that one right, from the University of California. No, it's the, boy, I'm doing good. University of Southern California. And he completed the classes required to sit for the CPA exam at the State University of Los Angeles. While at USC, David was a member of the Trojan debate team and competed successfully on national levels in cross-examination, debate association. David graduated cum laude and earned a lifetime membership in the Forensic Honor Society. Now let's hear, eagerly awaits, and let's hear from David. David, we're going to let you share the screen and take it away.
Okay, thank you, Sheldon. Appreciate it. I would say bios are like sandwiches. They're always better when somebody else makes them. But be that as it may, fasten your seatbelt because we have a lot of ground to cover regarding charitable deductions and contributions and things of that nature. You're going to have to forgive me if I glance down occasionally at my notes. I do not have a teleprompter, so I'm going to do this the old-fashioned way, like Walter Cronkite reading the CBS Evening News, if anybody remembers that. Speaking of old-fashioned, let's dive right into our first point. The classics never go out of style. Paul Newman and the Young Philadelphians, his tax lawyer. What does that have to do with anything? Well, here's the thing. If anybody's ever seen that movie, it's set around 1959, 1960. And the Internal Revenue Code was first codified in 1954. And it's a story about a young man with a hardscrabble background who becomes a lawyer and wants to work his way up the financial and society ladder. And there's a great scene in there where a very young Paul Newman, and by the way, I would add here as an aside, I think it's interesting that the tax lawyers always get those handsome leading men. Paul Newman in this movie, Tom Cruise in the 1988 movie, The Firm. And if you'll note, the CPA is always like the little skinny guy with the thick glasses and the squeaky voice. Well, be that as it may, flashback to this scene in the movie where Paul Newman is going over the will of a very wealthy client, and he notices that her tax strategies are not as optimal as they could be. And at the time, the reason they portrayed him as a tax lawyer in the book and in the movie was because the tax code was relatively new and tax law was a relatively new field. And they felt that as a young person wanting to come up and make his mark in the law firm and in the world quickly, tax as a new field would be a good place for him to do it. So back to the movie. He notices that this person, this wealthy person who's looking for deductions, has been selling property and donating the money to charity. And he says, no, that's not the way to do it. The way to do it is when you have appreciated property, say, for example, stocks, real estate, whatever it may happen to be, the thing to do is you donate it directly to the charity, and that way you get a write-off for the fair market value, the full fair market value of the property at the time you make the donation. And what happens then is you get a much better write-off because that way you don't have to sell the property and pay the capital gain on the property that you sold. The property goes directly to the charity, you get a much bigger write-off, and the charity gets a better deduction. Let me give you an example. Let's just say we had stock here and we bought it years ago for $100,000. and now it's worth $1 million. Okay, so rather than sell the stock and donate the cash, let's just donate the stock directly. Now, what does that mean in terms of the amount of money that you're going to save? Well, that's going to save you added tax of about $108,000, assuming you're in the 40% combined bracket. And the charity is going to get an extra $270,000. So it turns out, after all, Paul Newman, even though he was a very young lawyer, knew best. And this exact strategy is still viable today. So the takeaway is, don't sell the property and donate the cash to the charity. Donate the property directly, take a write-off for the full fair market value of it, and you get a much bigger write-off, and the charity is going to make more money. Now, let me add one caveat as a warning here. If you're donating property to a charity of over $5,000, you have to have it appraised. And not only do you have to have it appraised, you have to have the appraisal added to your tax return. You have to include it in your tax return when you mail it in. And if you don't do that and the IRS audits you, guess what? Completely disallowed. And there is no going back on this. Every tax court case I have ever read where the taxpayer has not attached an appraisal to the tax return, the IRS has won on this, and it's been a big hit for the taxpayer. So remember, attach appraisal for property that, typically this would be art, land, jewelry, things like that, or you're going to be in a lot of hot water if you get audited by the IRS. Okay, so let's go to point number 2, and that would be the new 100% charitable deduction, or beware of Congress bearing gifts. Who would have ever thought that? Now, let me give you a little bit of history here. The limit to the amount of charitable deduction that you could write off has been 50% of your adjusted gross income ever since George Washington was in high school. That changed with the 2018 Tax Cuts and Jobs Act, where they upped that limit to 60%. So what that means effectively, and let's just say your gross income is $1 million. The most you can write off for a charitable contribution would be $600,000 in that particular year, no matter how much you gave, and the balance could be carried forward for up to 5 years. So obviously, it doesn't make a lot of sense to give $100 million at once, because you'll never be able to realize the full benefit of that charitable deduction. Now, along came COVID-19, and as part of the cornucopia, there's a word for you, of tax legislation that came out of COVID-19, they decided, well, here's what we're going to do. We're going to say for the years 2020 and 2021, if you give money to charity, you can write off up to 100% of your of the tax deduction value of that of the value of that property. So effectively, what that means is you could negate all your income tax if you gave enough money to charity and pay 0 tax. Is that a good idea? Well, probably not in most cases. Well, why would that be? Well, you have to understand the way the brackets work in the way the brackets climb up in terms of how you're taxed. For example, income above taxable income of $622,000 is taxed at a maximum rate of 37%. I'm talking federal, not state. Now, income of $171,000 and below is taxed at anywhere from 20%, 22% rather, to 0%. Now, what does that mean? That means that the higher my income, the more my charitable deductions are worth. So I wouldn't want to take my charitable deduction all the way down to 0, because what I'm doing is I'm using a valuable deduction at the very low levels when I'm down below 171,000. It's better to split it between years or carry it over to where you can use it in a higher taxed year. For example, we still have time in 2021, because this was an issue in 2020 and 2021. It expires after 2021, but there's still time. So let's say you wanted to make a gift in 2021, a large gift. You could make the gift large enough to use up your income tax brackets at the top brackets, and you'd have to talk to your CPA or tax advisor to figure exactly what that number is. you could do that in December. And then once the new year starts again in 2022, you can make another gift, the second half of the gift in 2022. And that way, the bottom line here is you can maximize the value of your charitable deductions by using them against high tax income instead of low tax income. And this occurs on a regular basis, by the way, when you have capital gains property, when you sell appreciated property, say stocks, real estate, things like that. They're taxed at a maximum federal tax rate at 20%. You have to balance where you're taking deductions. It doesn't necessarily make sense to take deductions that are worth ordinary income, that you can deduct it up to 37% against ordinary income and deduct it against low tax capital gains property at 20%. So this is the very careful balancing act that you always have to do to say, you know, what do I want to deduct? What do I have as income? How can I match this up so I get the most bang for the buck out of my taxable income? Okay, moving on to point 3 of alphabet soup, IRAs, QCDs, CRATs, and CRUTs. Now, I have to give you a warning here. There's a general rule in tax practice that the longer the acronym, the higher the legal and accounting fees to implement it. So when you get into some of these, they can become quite costly to implement. But I do remember, just as an aside, when I was taking the section on charitable giving and trust and estates in accounting in my accounting tax course, and I hadn't really decided what kind of accounting I wanted to specialize in. Did I want to be a cost accountant? Did I want to be a tax accountant? Did I want to be a government accountant? You know, I walked into this tax class and there are all these acronyms and all this stuff about trust and estate law. And I remember saying to my professor, I said, how can anybody understand this stuff? And he says, well, the point is, you don't have to understand this stuff. When you're talking about this area of taxation, the beauty of it is, it's so complicated, nobody knows when you're wrong. And I thought, wow, this is great. This is the exact right place for me. And it turns out it was the right place for me. Anyway, QCDs. What the heck are those? QCD stands for Qualified Charitable Distribution. And this is basically donating your IRA to a trust in a manner to where it's most tax effective. Going back a few years, Congress passed a law and they said, you know what? Here's what we'll let you do. Rather than cash out your IRA and have to pick it up as income and then donate the money to charity, we'll let you donate the money from the IRA directly to the charity involved. And that way you don't have to pick it up as income in the first place. And you can do this for up to $100,000 per year per taxpayer. So a married couple could do $200,000 a year, which is a very nice tax deduction for most people. So what does that mean? And why is this better than cashing in the money and then donating it to charity? The reason it's better, and if you take nothing else away from today's seminar, you probably want to take this. It's always best to lower your adjusted gross income, because when you lower your adjusted gross income, as opposed to increasing your itemized deductions, it gives you benefits in other areas of taxation, because a lot of things are dependent upon adjusted gross income. Now, you can use these distributions up to $100,000 a year. It qualifies as your required minimum distribution. You can do $100,000 a year, and you can do it starting at 70 and a half. You don't have to wait till you're 72 and a half. So a couple things just to note about that. There is no double dipping. The donation goes directly to charity, but then you don't get to deduct it again. You get the deduction by virtue of the fact that you didn't pick it up as income. Be sure you do a direct trustee to trustee transfer. Don't cash it in and then write a check to the charity. That'll put you in a bad place. And you can only do it for contributions you made to the IRA before you were age 70 and a half. Okay, so of CRUTs and CRATs, what the heck are those? CRUT stands for Charitable Remainder Unit Trust, and CRAT stands for Charitable Remainder Annuity Trust. And they're both just forms of charitable remainder trust. Here's how these things work in a very simplified example. Let's say you have a lot of appreciated property, land, stock, whatever, and you don't want to pay the big capital gains on it when you cash it in. But you want to cash it in and create a cash flow for yourself, and maybe you want to donate to charity. This is an opportunity for you to increase your cash flow, maybe in retirement, and help your charity. because you donate to the property to the charity now. And what you do is you get a nice charitable deduction based on the value of the property that you donate, discounted by the present value of the property. That's an actuarial calculation, and we need our actuaries very badly. It's a very critical issue in tax law, even though, as they say, an actuary is just somebody who didn't have the personality to be a CPA. Be that as it may, we trust them to do those calculations properly. Let's say we donate a piece of property worth $1 million, and they do the actuarial calculation, and they say, okay, you get a $400,000 tax deduction right now that saves you on your taxes. We then set up an annuity in the charitable remainder trust. You get paid for life plus the life of your spouse, and this works out very nicely. Let me give you a very quick example with some very simple numbers. Let's just say you bought stock for $100,000, 20 years ago. It's valued at $1 million now. If you sell that stock, pay all the taxes, and then invest it in municipal bonds, depending on the interest rate, your return will be about $31,000 a year. If you use the same scenario, donate the property to the charity, let the charity sell it, and then invest it in municipal bonds for you in annuity, it ups your cash flow significantly to about $68,000 a year. So that's more than double the cash flow by using this charitable remainder trust. Well, how can that be? The reason is when the charity sells the property, they don't pay any capital gains tax. It's tax-free to them. So there's more money to invest. The second thing is you're going to save actually about $420,000 in taxes by donating the property to the charity. And what that means, you can reinvest that money, and that it adds further to your tax flow. So this is a very, very nice deal for everybody. You save taxes, you get a secured flow of income, and you help your favorite charity. There are a few things you have to be careful of. You need to make the annual payout of at least 5%. The term can't exceed your life or 20 years if it's not going to you. It's a very nice way to go. And one thing that makes people a little bit reluctant about this is, well, they think, after I die, the property then goes to the charity, right? And they say, well, it doesn't leave anything for my kids. One way around that is to use some of this extra cash flow and buy an insurance policy, life insurance trust, like what Kevin was talking about earlier, in an irrevocable life insurance trust that's called an ILET. Okay, there you go with a long, expensive acronym again. And then when you pass away, the money from the life insurance trust goes to replace the property that the kids would have otherwise got. So again, everybody's a winner. There are endless variations on these CRUTs and CRATs. There's something called a NEM Cut, NIMCRUT. That's net income with makeup charitable remainder trust. And that basically happens when you have non-liquid property, again, art or land, you donate it to the charity now. Nothing happens until you say retire. They sell the land or art at that time, and then you start the annuity. But in the meantime, you do get the nice tax deduction. Okay, so that's the basic overview of these charitable remainder trusts. An excellent, excellent way to secure retirement money, to help your charity, and to save on taxes. Okay, last but not least, as we've got about 2 minutes to go for time discipline, I'm going to give you the bonus here, the missing appraisal trap, and oh, my aching joints. Well, I really kind of talked about that missing appraisal already. I jumped the gun on that. And that is, if you're donating property to charity, as I said, over $5,000, be sure you get it appraised and be sure you attach it to the tax return, which, by the way, means you can't e-file. You're going to have to file a return on paper, and just be sure you do that certified mail, return receipt requested, which is the way I advise sending everything to IRS. Okay, but my aching joints, what does that mean? Well, that means joints as in joint tenancy. And every time I do a talk about trust or estates or tax, I like to let people know that it's possible that keeping your property in joint tenancy could be a tax disaster waiting to happen if you're a married couple. The reason is, when you keep property in joint tenancy instead of in community property, when the first spouse dies, you only get a step up in basis of 50% rather. Whereas in its community property, you get a step up in basis of 100%. Let me give you a very quick example using my own parents who are now 92 and 95, with my father coming up 95 in a couple of weeks. They bought their house in 1969 and they paid about $40,000 for it, okay? Now it's worth, depending, about $1 million, go figure. They've lived in the same house since that time. They own it in community property. If my father passes away first, or whichever one passes away first, the property will be revalued, will get a so-called step up in basis for income tax purposes to $100,000. That means on the way back from the funeral, if my mother sells the property, her real estate, her tax will probably be zero. She'd actually probably have a loss on it by the time you take that into consideration. Because if it's valued for tax purposes of $100,000, talking, or rather $1 million, I'm talking income tax now, not property tax. If its basis becomes $1 million and she sells it for $1 million, the tax is zero. And I see a lot of people where one spouse died, they're still stuck in their house, and they don't realize that they can sell their house without paying any taxable gain because they get to step up in basis because they had community property. And that revalues it to the fair market value of the date of death of the first spouse. Now, the problem is if you had an joint tenancy, you don't get that 100% basis step up. You only get the 50% basis step up. So in my mom's case, the house would be stepped up in basis to maybe say $540,000. And if she sold it for $1 million, she'd pay the difference between the $540,000 and the $1 million. She'd pay the capital gains tax on that, irrespective of any other tax breaks that might come into play. So you really need to consider, if you're married, holding this property in community property rather than joint tenancy. And now in California, as I'm sure Kevin will tell you, we have community property with rights of survivorship. So we don't even have to go through probate when the property is held in community property. So that kind of brings us full circle. I think I'm right on time here. Let me switch it over back to Sheldon, and hopefully you got some good information there, and I appreciate the opportunity to speak to you today. Thank you.
Hi, David, thank you so much for those really helpful tips. There's a lot of great information. Looks like we're just about on time with our program. Kevin and David, I want to thank you both again for a very interesting and helpful presentation. If any of our attendees would like to reach out to either of our speakers, here is their contact information. As stated earlier, this webinar is being recorded, and it will be available later. Now I think that we'll put the screen, there it is. I see the Kevin and David's information. And I think, Andrew, I'm not seeing the question and answer button. Were there any questions?
So Sheldon, you will have a Q&A menu hopefully at the bottom, but at this time we don't have any people. Folks are being shy, so don't be shy. If you have any questions, feel free to use the Q&A icon at the bottom of your web browser and ask away so our panel can respond to your questions.
You know, while you're bringing those up, I want to just say, I guess I can put this up before. I would do it after the question and answers. But before we go on to our questions, I'd like to give a little shout out to our community foundations of the Verdugo CEO, Edna Kurinsky, for coordinating the webinar, the logistics, and for a warm thank you to Andrew Cesilak, Interim Scout Executive with the Boy Scouts of America Verdugo Hills Council, for his webinar production assistance. Part of the Scouts Oath is to help other people at all times. So we appreciate the collaboration and the collaborative effort for today's webinar. Thanks also to Delynn Russell, our great chairperson of the Community Foundation of the Verdugos, who does just an excellent job for her role as host today and for her leadership in helping to make these educational webinars possible. Now, do we have any questions?
So we've had two come in. Kevin's actually helping to answer stuff via text, but
Kevin,
would you mind?
Great,
maybe
because I can't
helping
see the
to-
question. So if
Yeah,
Kevin,
sure. Someone asked if it was possible to get our materials, and I'd indicated I'd be happy to send you mine. I'm sure David would be happy to send you his. Just send us an email at the emails below, and we'll forward you our presentation materials.
Sure.
and the second question.
Someone asked, what about people with no kids? Those are the toughest estate plans to do because they never fit into a cookie cutter type of trust. So you should really go see your estate planning attorney on that because it does take some real customization to make sure that your assets go where you want it to go.
For couples with no kids, I recommend a German Shepherd.
Well, there are pet trusts.
There are.
I think if there are no further questions, all right. Am I correct? There are no further questions?
We have three more, Sheldon. People
Oh,
are, which is great. So
Yeah.
with respect to charitable remainder trust, how do you get over the hurdle of a taxpayer that is not very charitably inclined?
Well, that's why they call it a charitable remainder trust. Your person has to want to support the charity. So yeah, there are two words in there that might be a problem. One is charitable and the other is trust. So you might not be talking to the right person.
Well, there are some ways to minimize the amount that goes to the charity at the remainder of the trust term. So when you do the actuarial numbers, you can structure the trust so that you get a maximum return and that the charity, at least actuarially, gets the minimum amount required to make that trust a charitable remainder trust, which is 10% of the remainder. So if you at least actuarially plan for 10% going away, you can still qualify as a charitable remainder trust.
And by the way, what can happen, it's not supposed to, but sometimes if they mess up the actuarial calculation, sometimes the charity winds up with zero.
Yeah, for sure.
Yeah, and ironically enough, it doesn't retroactively negate your deduction. So the moral of that story is, hire a good actuary.
The other thing to note with respect to that is these actuarial formulas that the IRS uses to do these calculations are all based upon their actuarial tables from 20 years ago. So they're all based upon an 80-year lifespan. So many of us will be living beyond 80 years. So you're really going to get a more of a benefit, presuming you live your life expectancy. You're going to get more of a benefit out of the charitable remainder trust than the tables provide.
This is true.
We have another question. Is there a website to check in order to see what actually gets put into place by January of 2022? Or how should people keep up with the news as it develops?
KJMlaw.com. That would be one. Send me an email. I'll put you on my email list. We send out updates pretty regularly. We don't inundate, but obviously when important things are developed. So that would be one way. Also, you could just Google for the changes, and that'll pop up as well.
The Wall Street Journal is real good about tracking this stuff, and they present it in such a way that is generally easily understandable also.
Excellent. All right. Next question. Actually, David, this one's for you. Could you clarify if a gift from an IRA is tax deductible or not when given to a charity?
Well, yeah, that's the whole point of the qualified charitable contribution. The IRA goes directly to the charity instead of to you. So you get the deduction by virtue of the fact that you don't have to pick it up in income. So rather than you get the 100,000, cash the check or put it in your bank and make the deduction to charity, the 100,000 just goes directly to the charity. And in effect, yes, it's tax deductible in essence.
As a follow-up to that, does that apply with all IRA distributions or only when an individual has hit the age threshold for mandatory IRA distributions?
You have to be 70 and a half in order to make this work.
Great. Thank you.
Actually, you know, I'm not, actually, send me an email. I'm not positive about that. Let me see. Yeah, I'm pretty sure it's 70 and a half, but send me an email and I will double check that.
Okay, great. And then Kevin, any giving strategies for giving real estate to grandchildren rather than children? So maybe doing some generation skipping.
Well, for sure, we really like doing that, particularly on an indirect basis where the child can get the benefit of the real estate for the child's life and then it passes to the grandchild. You could also do it directly into a trust for the benefit of the grandchild where you just skip the child completely. You're allowed to do that up to your generation skipping transfer tax exemption amount, which is equivalent to your estate tax exemption amount, which is currently $11.7 million. So that means that without incurring any generation skipping taxes, you can give up to $11.7 million to your grandchildren. And that also is scheduled to go down January 1st, 2026, and will go down on January 1st, 2022 if the law does in fact change. There's very little you can do. There's very little you can do now with property tax reassessments on transfers to children. Most of the ways that we're getting around the transfers to children with real estate is through the use of LLCs and partnership interests. Those rules regarding reassessments and the transfer of a partnership interest or an LLC interest have not changed. So there's many things that we can do with respect to preventing a reassessment or delaying a reassessment for a long period of time using various entities. And as a result of that, it gives us more flexibility to provide for LLC interest to grandchildren. Because under the former law, even when we were able to give property tax-free or without reassessment to the children, we weren't able to do that for the grandchildren, unless both of the grandchild's parents were deceased. That was the only way that we could prevent a reassessment. Now, I mean, everything gets reassessed unless you use these entity interests. So that's kind of the big thing going right now to prevent property tax reassessment.
Okay, and I believe that was our last question for this afternoon.
Great. Excellent, excellent questions. Thank you, everybody, for participating. And all right, everyone, that is about all the time we have. And thank you again for attending. A recording of this webinar will be available soon from the Community Foundation of the Verdugo's website. And we will also email a link for the recording to everyone who signed up today. If you have additional questions about today's webinar or about the Community Foundation of the Verdugos and how it might help you to help your community, please reach out. Until next time, thanks everybody for attending.